This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to Market Exchange, a segment of Mackenzie Investments, the Invested podcast. My name is Dustin Reid. I'm the Chief Fixed Income Strategist here at Mackenzie in Toronto. Today, I want to talk about the Fed and Bank of Canada decisions that happened earlier today. We're recording late afternoon on April 29th. But before we get into that, I'd like to talk a little bit about what's been happening in markets and what's driving markets and some of the outlook that we have going forward for our team and some of our funds. As everybody knows, there's been continued hostilities in the Middle East. The active hostilities have calmed down, thankfully, but there's obviously been a significant escalation since we last spoke on this forum around a blockade around the Strait of Hormuz. And that has obviously caused significant strife for oil exporters around the Gulf region. And we've seen very little traffic go through the strait. As a result of that, energy prices, not only oil, but also liquefied natural gas, LNG, and helium, and fertilizer, and a lot of other input prices, not just oil, have continued to climb higher. And today, on Thursday, just looking over my shoulder, it looks like we have seen another fresh high close in Brent oil, which is generally seen as the global benchmark, right around $120 a barrel. The recent high, or at least the most recent high in that, came about a month ago on March 31st, actually at around 118. So a lot of people over the month of April believed that we had seen the high in oil in particular, and markets had been trading as such. But over the last week or so, I would say since last Thursday or Friday, we started to see a few things in particularly the short-term inflation market that started to cause some concern. So I'm not completely surprised to see Brent oil close at a fresh high today. Late last week, we saw some more weedy things within the inflation market, the one-year CPI swap rate, and then the one-year CPI swap rate, which is effectively what do people think one-year inflation is going to be 1 year out, start to move higher. And it started to gap higher earlier this week on the 27th on Monday. And we've reached cycle highs in the one-year CPI inflation swap rate, as well as for the one-year CPI or inflation swap rate. And that, I think, is starting to percolate and reverberate throughout markets, not just fixed income, but all asset classes. You're clearly seeing a little bit of risk around that. In equities, the US dollar is bid again. The carry trade is a little bit on hold, and you're starting to see credit spreads widen again. But more germane to my kind of day-to-day, week-to-week in the fixed income side, you're seeing the term structure of interest rates move significantly higher. So for those of you that have seen us in person over the last 3, 4, 5 weeks, you've heard me say and kind of repurpose this idea of higher for longer, which of course we talked a lot about during the pandemic on some of these podcasts. I've repurposed it a little bit, higher for longer from an energy complex perspective. And I'm concerned, and I have been concerned, and I would have said the same thing 3, 4, 5 weeks ago, that we are going to see higher energy prices, oil and those other commodities that I was talking about a minute ago, continue to move higher and stay higher for a prolonged period of time, maybe more so than the market was really pricing. And I think the last week have, somewhat unfortunately, seen that come true. That higher for longer narrative within the global energy complex is also leading to higher inflation expectations for longer. And again, I would reference what I said a minute ago about the one-year CPI swaps in the short-term inflation market and the one-year CPI inflation swaps. And that, of course, is having an impact on all yields, really, globally, particularly focusing here, at least for the moment, with the U.S. We've seen 10-year notes trade as high as 442 today, which is a cycle high. And we've seen 30-year bonds in the U.S. flirt with 5%, which we haven't seen for a while. 2-year notes are also up from a yield perspective relatively significantly. And with the Bank of Japan also looking to hike rates, the energy impact probably more from a relative perspective impacting Europe than North America. You're seeing yields globally move higher. And then, of course, you're seeing the Canadian yields move higher as well on the back of that. And we'll talk about the Canadian yields in detail in a minute when we talk about the Bank of Canada. So this is obviously having a significant impact on all asset classes, equities and just broad risk, which have had a pretty good run, I would say, for most of April as energy started coming off, particularly for the first 3 weeks, have now hit a bit of a wall. And I think that if oil continues to move higher here and the broad energy complex, it's going to be difficult for high beta assets to outperform, particularly getting a little bit more concerned about some carry trades. And those that are looking for to be long nominal duration, I think is not necessarily the play at the moment. Probably a good place to focus if you're focused on fixed income is what we would call the linkers market globally, or real fixed income. In Canada, that's generally referred to as real return bonds or RRBs. And in the US, of course, that's referred to as TIPS, Treasury Inflation Protected Securities. And so we've switched some of our duration away from nominal fixed income to real fixed income and focusing a little bit closer to the short end of the curve, or at least the belly of the curve around the 5 year space. I believe in this higher for longer energy complex narrative, and I've been saying so for the last 3 or 4 weeks on the road, and probably a little bit more before we went out on the road, maybe the week or two before that. And I think we're in it, as I like to say, and I think we're in it for a while here, unfortunately. That's going to be challenging for not only investors, but also for consumers. Disposable income, because of higher prices at the pump, because of higher prices just from a regular inflation perspective, is going to continue to get crimped a little bit, particularly, I would say, for the bottom half of the income spectrum. That disposable income is going to be going more towards energy related things. Food prices are probably going to continue to move a little bit higher. Again, fertilizer is a very big input into food prices. And other things like transportation. Everybody knows that airfares have moved higher significantly. We're going to see more of those types of things start cascading through the economy. It may not be right away, first month or two, but I mean, if we're having this conversation in June, or at least late May, early June, then we're going to be particularly concerned, I think, around not only higher inflation, but the risk of a global growth slowdown. We had targeted in March 120 in Brent as kind of the beginning of the level where we might start to talk about a stagflationary environment, where we start to see markets talk about higher inflation and lower growth globally, and as well as from a country perspective. With Brent closing today at 120, I would expect that conversation to increase in terms of what people are talking about in markets and within the press. So I think that's something that we want to be keeping an eye on here. It will be very interesting from a fixed income perspective if we do start to trade the thematic of lower global growth or a global growth slowdown within the context of higher inflation and what yields will do. At some point here, nominal duration could be a buy, but I think we are a few weeks away from that. And I'm still leaning towards buying duration from a real perspective. The Fed has started to acknowledge this. Today, we just finished the Fed meeting this afternoon. A press conference wrapped up about an hour ago. Very likely it was Chairman Powell's last press conference. Some of the big takeaways from the FOMC meeting are that Powell looks like he's going to stick around and claim his governor's seat, as is his right to do, from his original 14-year posting back when he was elected to the Fed back in the late 2000s. So I think he will show up as a governor, assuming that Warsh makes it through the Senate vote, the full Senate vote, which is likely to happen in the next couple of weeks. But earlier today, before the Fed meeting, Chair-elect Warsh made it through committee on party lines, with all the Republicans voting for and all the Democrats voting against. I believe it was 13-11. So he'll go to a full Senate floor vote and presumably pass, or at least be very close to passing. And he should be the new chair, not only of the Fed, but then subsequently get elected to be the new chair of the FOMC, related but technically separate. Today's Fed meeting was not a forecast meeting, but it felt like one in many ways. The statement had a few amendments to it. I read the formal statement actually as a little bit more incrementally hawkish, but we had 3 dissents from a forward guidance perspective, generally the more hawkish people on the voting committee, that started talking about not agreeing with the forward guidance around being dovish. Their statement didn't really match up with how I and a number of other people viewed the actual formal statement, which was kind of odd. And I think this happened because with Warsh coming in, presumably, and some concern that Warsh wants to cut rates regardless of hot inflation and an economy, underlying economy that's doing okay for now. I mean, keeping in mind what I said about higher energy a minute ago, I think that there's a bit of a public pushback happening from a few people on the board, effectively saying that Warsh or the chair is only one vote, and they are not afraid to voice their concerns publicly going forward. It is a very divided Fed. I think it's a very collegial Fed, and I think there are very robust conversations happening around the table. But the end result is still a divided Fed, and you can kind of see that with the vote result today, not necessarily for rates, which was 11-1 to keep rates on hold, but for the trajectory of the forward guidance of the statement, which was 8-4, which we really haven't seen in quite a while. One of the other things that was a good takeaway from the press conference, we talk a lot on these podcasts around the Fed and kind of the left flank or the dovish flank and the right flank, the hawkish flank, when you think of a dove hawk spectrum for voters across the line. Powell effectively said that the left flank, the dovish flank, was moving much more towards the center. And so there's a much more centrist or neutral bias happening now at the Fed versus maybe 1 or 2 meetings ago. And I think that that's obvious. The market was already there. You can see it obviously in the dissents in the statement. And Powell himself was really not particularly leaning towards additional easing or cuts. And he did spend a lot of time talking about the need for vigilance around the inflation story and his own view. And I thought he was a little bit more casual, given this was probably his last press conference. He really said that the labor market was doing okay. It was a little bit weak, but generally doing all right, which has been my view, I would say, and our view for a while. Certainly not falling off a cliff, deteriorating, but certainly not falling off a cliff from a labor market perspective. And so I think that the center of the committee is really migrating towards that viewpoint. So the market now will be really having a true two-way discussion, I think. I mean, we have to get through the June meeting, but for the second half of the year, will the Fed do nothing? Will the Fed be hiking? Will the Fed be easing rates? And I really think you can, I guess, in many ways, having a three-way discussion on what the Fed will be doing. There are clearly some people that are going to be looking for Fed hikes at some point later this year on the committee and in the market. There will be people looking for the Fed to do nothing, and there will be the people looking for the Fed to ease rates. It will be quite interesting. With Powell sticking around for as long as he believes is necessary due to the ongoing legal issues outstanding with the Fed, it would be very likely that Chair Warsh will need to take Moran's seat. Soon to be Governor Powell will have his own governor seat that he can slot in. And so the administration will effectively lose the ability to nominate somebody else to the board anytime soon because Powell is taking his governor seat over. And for Warsh to find room, he'll need to basically take the Moran seat, which technically ended at the end of January anyway. So it's not a logistical issue, but Trump and the administration lose the ability to have a new appointee on the board for the next little bit. Powell has said that he's not going to necessarily be a shadow chair and is going to be relatively quiet. He probably will be. He probably wants to let Chair-elect Warsh do most of the work for the Fed and give Warsh enough runway to find his own path and create his own consensus. Maybe turning to the Bank of Canada now quickly. Bank of Canada met earlier today as well. And I would note that the bank was probably coming out a little bit more hawkish than many people expected. And we saw the market price in about another half a hike, about another 12 and a half basis points ish for the bank by the end of the year. So we're now running at about 50 basis points of hikes by the market for the Bank of Canada by the end of the year. Importantly, and I didn't mention this a minute ago, for the Fed, the market is now flipped again from about minus 10 basis points, 10 basis points worth of cuts, to maybe about 2 to 5 basis points worth of hikes by year end, but it's bouncing around a fair bit. On the Bank of Canada, this was a forecast meeting for the bank, so we got the little bit more detail around forecast updates and those sorts of things. The bank is clearly concerned about two things that are effectively mutually exclusive and has really kept the door open for its next move. The bank did not move today as many people expected, but it's very focused on two things. One, what's happening in the Middle East, oil prices and higher energy prices. In fact, we actually heard Governor Macklem a few times talk about the idea of higher for longer. He used that exact language. And the bank also is very, very concerned, as are we, as am I, about USMCA renegotiations as we roll through Q2 and get into July. The higher energy story obviously seems to suggest, or if that were to persist and medium or long-term inflation expectations became unanchored, you would expect the bank to potentially hike rates, and that is the lean of the bank. Conversely, and somewhat at odds with that, if there are risks around USMCA and supply chain issues and aggregate demand and or consumption in Canada is expected to fall or falls materially, along with the declining population growth, of course, then the bank would cut rates. So the bank's really focused on those two things, and they are effectively polar opposite outcomes. It's pretty tough to tell exactly what the bank is going to do. I continue to think that there's going to be more risk around the renewal for USMCA. And so there are downside risks to the economy. As many listeners know, we've had a risk of the bank cutting by 1, possibly 2 times this year. And so with today's market move and how the market took the bank, we are actually further away from where the market is now and where consensus is now. So we'll be revisiting that view to see if that is the right call for our portfolios and our clients. But for a lot of the reasons that we believed the bank could cut this year, are still very much in place. Labor market is not particularly strong domestically here in Canada. There's been population declines, as everybody knows, in Q3 and Q4, and I would not expect that to particularly change in 2026. The USMCA continues to be a significant risk here, I think, going forward, maybe more so than the market appreciates. And of course, the housing market reset is not insignificant, and the bank also continues to believe that that's the case. Somewhat interestingly, despite the market reaction, looking for more hikes by the bank by the end of 2026, the bank, as part of its forecast update today, updated its ever famous output gap, which it uses not as the only driver, but as a key input into setting rates. And the output gap is the economy running at equilibrium, above capacity, or below capacity. And today, the bank said once again that not only is the Canadian economy running below capacity, but it's expected to do so until probably late 2028. So sitting here late April 2026, that's obviously a long time. So I still retain that view that the bank will cut rates later this year, but I'm open to maybe some different interpretations here, given that the bank may be looking at other things in the near term that it might be putting more emphasis on going forward. We continue to look for the Fed to potentially cut by 125 basis point move later this year. But again, I don't think that Warsh is going to be able to come in and cut rates right away. It's probably a September or a Q4 event, but that seems to be, again, kind of not the way that the market is leaning at this point, particularly given how hot inflation was before the hostilities in the Middle East and how things have evolved, obviously, in the spot rate, as we've talked about. Maybe a couple of trades that we have on in the portfolio. Again, to reiterate, we prefer real duration over nominal duration in the US. From a nominal perspective, we do look for Canadian duration to outperform US here. So yields lower quicker in Canada versus the US. We continue to hold some relatively sizable emerging market trades, particularly in Brazil and Mexico. But as I was discussing with the team over the last week or so, becoming a little bit more concerned about that with higher oil, global growth slowdown, and carry as a thematic not necessarily being as much in vogue as maybe it was a month ago. Brazil might be a bit of an exception here, of course, because their overnight rate is sitting at around 14.5%, which provides exceptional carry on a nominal perspective and maybe 950 or 1,000 basis points on a real perspective. A couple other trades that we have on, relatively neutral on outright Canadian dollar, although we are short Canadian dollar against a number of currencies, including those EM currencies. We are also short Canadian dollar against the Norwegian krona, expecting the fiscal story in Norway to be a little bit better than in Canada and to be a little bit better on the energy commodity complex uptake more than Canada. Maybe just quickly on the Canadian fiscal update before I end the podcast. We did have the update yesterday. I didn't see too much in there that was particularly important for markets, particularly given what's been happening with oil and short-term inflation CPI markets, like I was talking about a few minutes ago. It looks like the deficit is going to be a little bit better for the current fiscal year, i.e. lower, although I would say it's probably not as low as the whisper number that was going around earlier in the week and late last week. The Sovereign Wealth Fund is going to get seeded over, I think, a 3-year period for $25 billion. And of course, the Prime Minister's office and Prime Minister Carney is very much in full flux to try and get the investor conference of about 100 of the world's largest investment managers to Toronto in September. I believe it's the 14th and 15th, to show off Canada and to try and direct a significant amount of foreign direct investment. Could be very constructive for the economy and for the country over the long term from a structural perspective, but I don't think it's particularly market moving per se over the next number of months. The Middle East story and the energy complex story and rates moving higher, if they do continue to move higher, and how that impacts high beta assets like equities, credit, and high beta FX, I think will be much more of a driver, particularly for Canada. So with that, we'll wish everybody a great week and look forward to seeing you next time on Mackenzie Investments Market Exchange. The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.